see you getting fancy with it.
Yeah, we're live. Jolene, we're
Huh?
live.
Oh, you know what? You know what happened? I was like distracted by the intro video. So I'm like looking at it and I know the words. So I'm like saying the words to myself, forgetting that, there's a lag, a delay. So,
Oh. Wait, I wanted to know, we wanted to do a quick little test though. Everybody, if you can, on the chat, because we can't hear it. So let us know if you were able to hear the audio from, the music in the background. Hopefully, you guys like the song.
I wish I could hear it.
I know, right? It would have been dope because we could have been like, gig into it, but, you know. All right, so I guess everybody was like, yeah, we could hear the music audio. That is what's up. Thank you, thank you, thank you, thank you, thank you. Well, what's up, everybody? I am Mark Monroe, accompanied by my wonderful co-host, co-producer, and co-creator, and just awesome friend. And on top of that, completely coming out here looking all stylish and everything. Shout outs to the wonderful.
It's a jolyngc and a place to be. I should call myself LL Cool JGC, because
Oh,
I'm
Lord.
feeling. I am. I'm feeling very LL
Are
right
you feeling on
now.
some Mama Said Knock You Out vibes right now? Or some Hootie
Maybe
Love? Or...
I could not find my bamboo earrings though. I think I left them in Punta Cana.
Oh no. Well, I'm probably sure that, hopefully that they will turn up because, what's life without bamboo earrings?
At least prepare. They both gone.
Well, y'all, let's get some stuff out of the way. If you haven't subscribed yet, go ahead and hit that subscribe button down below so that way you can see all the wonderful content. And on top of that, if you want to be in the know, just like who was first today, Jolyn? Do you know? Because,
Yes, it was the homie Jalen.
What's good, Jalen? Mr. Jalen Graham, you were first here because you had your notification bell set, ready to go, and you were first. So if you want to be like Jalen, go ahead and hit that bell so that way you could be first, possibly, and we can shout you out on our next video. And on top of that, if you like what we do, or if you like Jolen's LL Vibes outfit, and on top of that, the content and what we talk about, then go ahead and hit that like button. So Jolene, did I miss anything? Or no? Because there's a lot that we got to get into today. I'm probably sure that there's a lot of
Um,
news. There's a lot of stuff.
I think we got
Like me, got
everything.
to turn off my phone on Do Not Disturb.
Oh wait. Okay. I think it's turned down. Yeah. I do want to say Johnny was right on the dot. He was the first person to be in right at 5:30. So
Okay.
shout out to you, Johnny.
Shout out to you, Johnny.
And Reggie was second, so he was close. Reggie
No.
slipping.
We are only rewarding first. If that's the case, then we're going to go down the whole line, list kitten caboodle of everybody who is here in the chat. So, what's good, everybody? So, first things first, it's been a very, very interesting week. But, kind of shaky, kind of rocky, but y'all, earnings season is starting to just, it's starting to heat up. It's starting to heat up. But how do we do in today's markets, though, Jolene?
I have so much to say. So much to say because this is the last trading day of January.
I know, right?
Or this was, So let me just say, hold on. I wrote really
isn't
tiny.
It tomorrow the last trading day of January?
Yeah, I told you before we went live. I keep thinking it's Friday. I'm tripping. It's the last day for the come up series on January. Okay, yes. So y'all gotta bear with me.
No. It's not. We got January 31st. We got Monday. It ain't over yet.
Oh yeah. Okay, I'm tripping. Scratch that. Forget I even said that, y'all. Just forget about it. Forget about it. All right, so here we go. We got the Dow coming in, fighting its way to something at 158 points. So now we're at a level of 34,201 points. Mm-hmm. The S&P 500 was up 27.25 points. Now we are maintaining levels at 4,345. The NASDAQ was up 163.5 points. And now we are finally back to the 14,000 level at 14,144. The VIX came down just a little sprinkle from yesterday to 30.49. We have the 10-year Treasury note coming up to 1.809%. Heading over to sector performance, Mark, as you know, we have 11 sectors, and here at the Come Up series, we like to track the top 3 and the bottom 3, so we can see what that wicked rotation is looking like. We got energy, utilities, consumer staples coming in at the top. Then for the bottom is industrials, real estate, and consumer discretionary. Heading over to pick performance. I haven't said this in a long time.
I know.
But you can find our picks on our Instagram page at that Come Up series. It's subject to change. We are working on it. There's a lot of stuff going on behind the scenes, y'all, so just bear with us. But we got into it, bringing in 1.92% to the upside. We have MasterCard up 1.7% and a Disney coming in at 1.36%. Now, for these underperformers, we have, I want you guys to write these ticker symbols down. I like to switch it up. I don't always say for the company. So we got CACI negative, y'all, 8.37 percentage points. And then we have another ticker symbol. I don't know if you guys know this one, but it's TSLA. Negative 11.
Just right now. All right.
Those looking like good levels though. Then we got Lucid at negative 14.10%. Now, this whole time I've been thinking that, well, one, I've been thinking it's Friday. Two, I've been thinking the month is already over for trading. I forgot all about Monday, as far as that still being in January. But Mark, so far for 2022, it's been a bang. Like, we've started with a very rocky bang, okay? So we've had 3 weeks of consecutive declines.
Correct.
Back to back. So overall this time, y'all, we have talked about, if I were to sum it up, it's been like about 5 areas that, if you go back to, even in December though, I mean, not December, but as we were leading into, before we left, and then we came back in January, we've been talking about, obviously, economic data, like the importance of knowing that, right? Mm-hmm. We've been talking about how uncertainty leads to volatility in the market. We've also been talking about, obviously, the monetary policy. That's a key thing. I think these are things that we'll have to continue to talk about.
Yes.
And then, obviously, you've really stressed, Mark, for 2022 to look at the global landscape, including geopolitical activity.
Yep.
And we already know there's a lot of things brewing behind the scenes. So we just got to keep our eye on Russia, on Ukraine, on China, obviously United States. We just got to keep the eyes peeled.
And also what's happening over there in the UK as well, because, word on the street, Boris Johnson's days may be numbered.
So as you can see, there's a lot of stuff going on, right? So we got to keep track of that. But the fifth and final thing that we have stressed, for your portfolio, for paying attention to what's happening, is earnings. We have stressed that. So if you've been paying attention to those 5 areas on a regular basis, you are pretty much up to date about what's been happening in this market, as well as what's going to take place for 2022 in general, and probably beyond. But we just narrow our focus in just for the year so far.
Facts.
What'd you say?
I said #facts.
Yes. So if we just focus in on that, I want to talk about earnings in all those other 5 areas. As the recap, of what's been happening. So,
Yeah.
if you're just now tuning in to the market, not even just to come upstairs, but if you're just brand spanking new and, you're like, okay, let me get in where I fit in. Let's talk about where folks fit in.
Okay. Whew. So first things first, I gotta give a shout out. I gotta give a shout
Okay.
out to Apple right now.
Yes.
Apple right now is clowning in the aftermarket.
Like just beasting.
Like Apple right now up 5% in the aftermarket. And on top of that, shout outs to Visa, also up 5% in the aftermarket. So something to pay attention to. It's just something to pay attention to. Now, it was interesting because let's give a quick recap of what took place today that kind of set the stage, and also kind of like giving people an understanding of what's taking place right now in the market.
Yeah.
So remember last year where we had a lot of short interest that was taking place, and ultimately retail investors were like, hey, we're going to flex our muscles and stick it to the man.
Mm-hmm.
Well, I mean, I tried to warn everybody last year and saying that, hey, don't think that essentially that, that Wall Street bets and everybody else had won, because they didn't. You may have been fooled to believe that you had won, but those same short sellers came back, and those are the same short sellers that are literally adding in significant amounts of pumps towards specific stocks to lure in folks, and not really to lure in, but ultimately to gain value. I don't think that they're just doing that just for sport, but essentially they're allowing for the tick. Right now, this is a day trader's market, so to speak. Because if you notice, you see a lot of volatility taking place. You see a lot of movement to the upside, and then ultimately it kind of just seems like as the market weans on, it kind of like drops like a rock. And those are ultimately the place where you see a lot of short seller activity that's being put in place. So don't be surprised when you see the put to call ratio immediately drastically change for the day. And where essentially you start seeing that, okay, hey, we've made it up to a certain point, and then ultimately now we immediately just run to the downside. So I wouldn't be surprised on that activity. You typically see that time where in older days, so to speak, when we were getting ready to finish, or when we were kind of like close to the end of the correction, it was a mixture of folks that were ultimately buying X amount, or getting into positions, or beginning to go long on stocks or long on positions, but meanwhile covering in the short term for potential shorts. So they were long on specific companies, or specific positions within the market, and then essentially they were short on others, and that's essentially what you're seeing right now, which is ultimately creating a lot of volatility. And it doesn't help that you have a significantly amount of options traders. Shout outs to everybody. In which that we've seen a record number of options trading that is now out there. Now, do these things ultimately tend to settle down? Yes. The question is how long, and that's I wish that if I had a crystal ball, I could literally tell you that okay, hey, that it could stop tomorrow, or it could stop on Monday, or something like that. But that would be completely untrue. So I would say honestly, we were in a rocky month. I think that as we come out of this month, though, I think that we'll start to see that some of that behavior starts to subside a little bit. I mean, I think the biggest thing is that you can kind of see it because it's not just in equities, it's also within commodities or bonds, futures. You're seeing it across the entire landscape, across the entire board. So again, for a person who's playing on the daily or on the weeklies, and if they're good at it, then they're having a great time. For a person who's playing midterm to, say, for example, or midterm, it could be a little bit challenging. For a person who's playing long term, it's like you sit back and you watch, but honestly, you sit back unbothered. That's really where it comes down to play. Another thing is you see a significant amount of rebalance. Then on top of that, there's other issues that are at play, like for example, oil has yet again reared itself into the market, which is one of the best performers of 2022. Thanks to Brent crude and WTI, as well as on the natural gas side, which is ultimately causing spikes within oil. And of course, there's a lot of folks that are predicting that oil would go to $100 per barrel. But I don't know about that one, because I think that there are, it could, but then there's also this immediately I think that probably when it gets to about 100, I think that we'll probably see that oil will probably drop like a rock, and we'll probably be seeing oil around 69, 75,
Mhm.
around for the year, going for Q3, Q4. Um, so there's a lot that's at play here, and there's a lot in which that, if you really think about it, for a lot of money that sat on the sideline that didn't even participate in the last 2 years,
Mhm.
really, it's like this is their oyster. For the folks in whom which that have been in the market for the past 2 years, literally, you know, this is also something in which that you probably haven't seen before. I think the only time when I can probably recall this type of behavior for everybody to kind of like recollect was very much so at the very beginning when the market had went through a correctionary period right before the election. Before the election,
Yes.
we saw that the stock market had corrected, and that was around the time when there was this position called XLK that was like the hottest thing since sliced bread for the 130 strike.
Mhm.
Um, and after that correction, I remember going through that correction, and seeing everybody go through it. You saw that there was a lot of pain to the downside as the market had dipped 10%. So now when
Yeah.
we find ourselves, it's like the asking ourselves, is the market going to like immediately just bounce back like it used to? No, the market isn't going to do those things. It's going to
Mm.
go through what we call those real corrections where it goes through the extended period of time. And for those that don't understand, there was this video that we did a while back in 60 seconds where we talked about corrections and typically how long they last. They don't last forever, but they do go for periods of time in which that, okay, we've got to work ourselves through this. And it's not just on the fundamental side, it's also on the technical side. And then essentially we go through technical retest periods. So there's a lot of things that are at play before the market can really get back into gear. There's a lot of uncertainty about when it comes to investors placing their money on the table. If your position
Yeah.
is already on the table and if you're long on a position, then honestly it's like you're just gonna kind of have to wait it out. Um, and honestly, that's exactly where I am right now. I'm waiting out a lot of the things in which that are happening. I'm already in the market, so honestly, the only thing I do is just sit back and wait during these things. I don't really let the volatility and everything else really catch me. We've seen that the volatility has gotten up to 36, and essentially we're sitting down at like 30.
Yep.
So I think that we're on the downcline. If you watch the VIX is telling you we're on the downward decline, and coming off of the volatility, but these things take time.
Yeah, Mark, I'm right there in long-term positions, just kind of observing what's happening. And it's really interesting because I, well, I wrote down in the beginning of the year that I was not going to enter any new positions in the month of January. But because I didn't think anything was going to hit the levels I was looking for until like maybe the first week of February.
Mm-hmm.
But things hit and I got in, but then there was, some dippage, and then it resumed back to the level that I had it at.
Yep.
So, yeah, it is a waiting game. And it's not, it's
It's
not
not.
going to be like 2020.
It's not.
2020 was
It's not.
a cakewalk. It's not like
It's
that.
not.
It's
I
not.
mean, but the thing is, it's like It's like getting back into the swing of things.
Hmm.
The market still will be very, very rewarding to people. I mean, I want people to understand that, especially like what we said is as it pertains to setting forth your process, trading plan, understanding the current landscape and where you're at. It's not all doom and gloom like you read in the news and everything else. Though that as much as we see that, for example, inflation is very high, we're getting a lot of talk that's coming out of the Fed. A lot of those things are at play, but for the most part, I mean, honestly, those things tend to work themselves out and the market just moves on. That's really where it comes down to it. I think the other part is that you're seeing central banking across the entire global landscape, they're not on the same page.
Hmm.
Like that's another piece. We're not on the same page. Another thing is look at the dollar. A lot of the stocks don't look cheap as long as the dollar stays higher. we got to have some type of equilibrium there where we start seeing when we start seeing the U.S. dollar start to settle back down. When that settles back down, that makes it more attractive for international buyers to want to be buyers into U.S. equities. As it pertains to
Mhm.
right now, they're kind of just sitting on the sidelines, salivating, looking at the prices. Again, don't be surprised if you see small nibbles here and there, which is ultimately building up towards a lot of long-term set positions. But again, we're in this cycle of, in some cases, we're in a cycle of expansion. In other areas, we're in a cycle of, deacceleration.
Mhm.
Um, and it's just a matter of where is it that you're investing in and where is that cycle. I think the rotation and rebalancing I think that's over and done. I think that the next thing is that now folks are starting to line up in their minds and say, okay, hey, who are the winners that I expect to be winners over the next 12 to 24 months? And
Mhm.
those are going to be the ones that are going to be highly rewarded and invested into versus the ones that we expect to see, that we don't have a lot of faith in, that essentially that we can see that they have a strong upside or much more room for them to grow. Those are going to be the ones that are going to be, pretty much punished pretty badly. And I think that we've
Well,
already seen it.
I really want to talk about Apple
Okay.
and look at their earnings report
Okay.
because I mean they just really smashed it.
They
And
did.
when you think about this climate and Apple's just like, okay, y'all do what you do, we're gonna do what we do. And it's like,
Hmm.
wow,
So
Apple
let's
holding
so
it
let's
together.
so let's take a quick look. This is a quick note from Tim Cook from their newsroom. So let's go to
Hmm.
that, shall we?
Yeah.
Wrong one. Oh, no, no, no. That's it. That's the one. So let's go ahead and transition that again. Black screen. All right, so here we have revenue up 11% to new all-time record. iPhone, Mac, wearables, and services revenue reach all new all-time highs. So pretty much the street was looking for 118 billion dollars of revenue with an EPS of about 1.89. And as you can see here, Apple pretty much practically crushed it. I mean, coming in at 123.9 billion, up 11% year over year. So again, there's your double digit growth. And then on top of that, you had EPS at 210 when again they were looking at when they were looking for an EPS of 1.89, which is also a big beat. So going further into the quarter, here's a quote by saying this quarter's results were made possible by our most innovative lineup of products. Okay, so the typical spiel. But here's
Hmm.
something where it becomes very, very interesting. If you look at, say, for example, the services business was up, I think, double digits. I think that they had rate. I think the services business was either up, well, it could either be about 7% or all the way up to about 11%. I can't fully quote that right now because the numbers are kind of fleeting me. The only thing that was kind of light was the iPad revenue that came in light, but iPhone crushed it. I mean, so if I pull it up on a consolidated list as it pertains to also where the money came from. Now, keep in mind, this is in millions. So clearly, as you can see, as of December of last year, they brought in 111, clearly crushing it. Gross margin, again, crushing it, going from 44 to 54 billion. Services revenue, 4.9 last year or in 2020, 5.3 this year. So that's letting you know that essentially and here's the interesting thing about Apple, by the way. These are numbers in which that we say, okay, hey, Mark, these are good, but keep in mind, Apple has pricing power. So as they start to go up, as the company starts to appreciate, and as things start to move forward, and their services only get better, like for example, looking at Apple TV Plus, until when they are ready, when they have a full set lineup of actual content that is essentially something that where we say that the platform itself or that service alone can stand on its own, don't be surprised where you see Apple TV Plus go from about $5 a month to maybe probably being about $9 a month on its own. And that's just going to take time, but that just lets you know that there's pricing power there as it pertains to just improving on the margin side. R&D, they spent money. That's huge. So again, there were some operating expenses that went up. But then at the same token, operating income was up. Net income crushed it. And again, when you look at it across the board, 1.68 in EPS last year or in 2020 and 210 as of 2021. This is also something that you can look at as it pertains to a solid breakdown as well. So let's keep this into perspective. China, there was growth. Europe, a little bit slower, but look at what happened in the Americas. So this includes North and South America, significantly up. When we look at, say, for example, Japan, we saw a decrease. And that really goes into play where we say that, okay, hey, with Japan, we saw also deacceleration within Japan's economy. So that kind of makes sense because I think that Japan has been in somewhat of a small or slight recession. But then let's bring it into the full perspective and the full array. Again, iPhone sales in just in Q4 alone, $71.6 billion. Again, the iPad was weak in comparison to the year before, but across the entire lineup, just nothing but solid growth. And in this market, that is something in which that sooner or later we've seen that a lot of these companies are having significant beats across the board. And then essentially it's like they're up today and then essentially they're down tomorrow. But that's not entirely true, especially for certain bellwether companies, a la like your Apple and your Microsoft. Look at what happened with Apple and Microsoft, or with Microsoft. Microsoft essentially has been essentially back on somewhat of a rebound. Of course, it goes with where the market goes, but I think that those are the bellwether stocks, especially since they're the biggest weightings in the S&P 500. So again, something to be said here when we look across the entire board, and this is when you go into a little bit further in detail, but it's just something to be said when we look at it across the board that Apple literally had a blowout year, especially given the amount of supply constraints that there were. Also, given in the sense that I think one of the biggest things that was very telling that Tim Cook had discussed was a lot of their major sales, especially for the iPhone, came through in the last 2 weeks of the quarter, which was huge because that lets you know that essentially that maybe, just maybe, during the holiday season of gift giving season, that's where Apple really started to shine. So again, nothing but solid earnings beat, and again, they always just, for some reason, it's like when we always want to count them out as it pertains to what is it that they can do as it pertains to performance, boom, there it is.
All right, now what about who else did I want to look at? Hold on. It was mainly Apple, but what? Okay, so let's talk about Tesla right quick.
Yes, let's talk about Tesla.
Yeah, let's talk about Tesla because we didn't get to.
Here's the thing: it's like if we look at Tesla's earnings, Tesla had an amazing quarter. Like hands down, it was still an amazing quarter. What really killed Tesla was probably it was really the fact that Elon had said that we're not on target for the $25,000 vehicle, which shocker. Cybertruck, he confirmed that it was going to be released in 2023. Okay, so the Reuters article was true. I don't know why he dragged it on, but maybe, just maybe, and for all we know, this also could be something in which that if we see that those shortages start to subside a lot sooner than we think, then that could also bring the Cybertruck forward. But I still think that they're still in prototype phase. So 2023 sounds a little bit reasonable for me. And I'm okay with that because looking at what's coming out of the pipeline, look at the sales that are already coming forth for Model Y, Model 3, Model S, and on top of that, we expect to see Model X come out because there was a huge amount of backup and backlog for Model X coming from last year that a lot of those deliveries haven't even been fulfilled yet, where a lot of those orders got pushed forward to, like, if you were supposed to be having an order coming in September, it got pushed to December, and then January, now February and March. So those are the things in which that are just letting you know that they are completely backlogged, and it's kind of like it kind of feels like they're taking a page out of Boeing's book, where what makes Boeing so strong is the fact that its backlog is so significant that essentially it's like it's just really hard to touch. But I mean, if we must go through it, let's quickly go through a quick deck of Tesla real quick, just to see what happened in those earnings. So again, operating cash less capex was of 2.8 billion in Q4 in total, 1.5 billion increase in our cash and cash equivalents to 17.6. So that's just letting you know that they're starting to build up cash on the sideline. Put this into perspective though. In just a few years alone, Tesla has now gotten to $17.6 billion in cash. I want you to keep this in mind when we think about things in comparison, because Apple has about 200 and something billion dollars in cash. And this is just for Tesla within the equivalent of, what is it, a year and a half. So something to keep in mind. Also, one of the things that I had mentioned, which was the 30% profit or gross margin, something to take into consideration. But if you remove the tax credits, then ultimately it's 29.2. We knew the numbers. The numbers are what they were. Pretty much there was growth, 65% year over year growth, which they had only expected 50% growth. So that was huge, and that was just because of growth in deliveries. An interesting stat line that Elon Musk had mentioned in the call was the fact that they could literally be at 50% year over year growth just by using the Fremont and Shanghai gigafactories. So what does that mean when you add in Giga Berlin and Giga Texas online this year? So something to be said there. But then again, here's where it got a little bit, I'm going to come all the way down to the outlook, because this is the part where investors were like, I don't know about that one. That may be a no for me, dog. But the biggest part is, over a multi-year horizon, we expect to achieve a 50% average annual growth in vehicle deliveries. Please tell me another company that can deliver 50% year-over-year growth. And then on top of that, it's like they're letting you know we have sufficient liquidity to fund our product roadmap, long-term capacity expansion plans, and other expenses. So they're not strapped for cash. When it comes to profit, innovations to while we continue to execute on innovations to reduce the cost of manufacturing and operations over time, we expect our hardware related profits to be accompanied with an acceleration of our software related profits. The reason why I kind of went to that one and paused for the effect was there was another mic drop. Elon Musk literally dropped the gauntlet and said, "This is the year for full self-driving." Now, if Tesla can achieve that, I'm not going to say if Elon can achieve that. If Tesla can achieve that, the game is over when we look at it for vehicles. Like, the game is completely over. And here's why. When we look at the entire landscape of vehicles, when we think about EV and, let's say, autopilot features, or just EV and battery. So EV and battery tech, right? So that literally, once you've perfected those two, then really you've removed the necessary need for internal combustion engines. That's the first play. Once you bring in autonomy, or full self-driving, well, that literally blocks out that side of it. Now it's like, okay, hey, the entire idea of EV or the EV race, that game is over. And I think that what they're trying to do, and it's a very big undertaking, but what they're trying to do is to let everybody know that essentially that we've built up X amount of inertia as a company to literally make that transition from just being considered a car company to now we're going to start making those necessary transitions to show the world that we're also software and AI and even beyond software and even beyond, like, say, for example, the chip side, but more so an AI company. And I think that that's ultimately where the goal leads. He talked about a project called Optimus, which I challenge everybody to go read about that. But again, it's something, it's something to pay attention to. It may not be something, if you're a trader,
Mm-hmm.
that's not something that you want to bank in that long term, you know, that long term ideation, because that's going to
Mm-hmm.
take time. So you still have to stay focused on what is it that they can produce now, what's taking
Right.
place now. I think that, could he have waited to share that information at maybe an event or something like that? Yes. Because the only thing that when you tell that to investors, and Elon isn't the only one in this boat. Steve Jobs did
Right.
this years ago, back when he was alive. God bless his soul. When he started talking about the type of investments to investors, about going more so into a different product category, that literally spooked investors after he had came back and literally like said, okay, hey, here's the Mac, and here are some of the new devices. He spooked
Mm.
investors to let them know that capex spending would increase, but then, and the stock got hit heavily. But then at the same token, the next thing that came out was the iPhone and then the iPad.
Right. Which,
So,
yeah.
which is still, even till this day, long after he's gone, may he rest in peace, that the fact that, that's still one of the shining stars that is it eclipsed the first generation of what Apple once was, which was the Apple Mac.
Mhm.
So it's very interesting to see what's going to happen next. What is going to eclipse the iPhone? And I think that we're coming up very close to that. But it just lets you know that, okay, hey, when companies reach these points of reaching that point in innovation in the S curve, then now's that point in time where we're going to be, okay, we're going to see heavy capex spending. The other one that I could probably show folks as it pertains to a parallel is look at also what Jeff Bezos and Amazon did when they started telling everybody that they were going to do massive amounts of spending. Like during these times, this is where you
Mm.
start to see the titans really come to formation. During the hard times of the economy, the companies that are weak can't spend money. The companies that are weak can't put those dollars towards innovation to improve their process, not even just improve their process, but think of like to build the next generation. Why? They're so busy taking care of what currently exists that they don't have enough cash or enough wherewithal to also do what they're to focus on the current, but also build the future itself. Something's got to give. When we look at, say, for example, the innovative companies, though, they're spending money. They're spend like the interesting thing is, as we go through earnings, here's something as a tell for everybody that people are going to want to pay attention to. Pay attention to exactly their expenses, like their R&D. If they're spending a lot of money towards research and development, then that lets
Mhm.
you know that this company is not hurting at all. If they're not spending as much, and if it's very, very close to what they spent the year before, or say, for example, even less, either one, I'll give it the benefit of the doubt. Either one, they're on the cusp of a release, or two, essentially, it's letting you know that they're hurting for cash and that they need to hold on to cash, and that ultimately that cash needs to be sent elsewhere, and it's not going to be spent on still maintaining that leadership dominant role. And honestly, the market will sniff that out.
Mhm.
So again, just something to pay attention to. Another thing to pay attention to is M&A activity, because M&A activity is definitely going to start heating up. It's definitely going to start heating up for sure.
Yeah, especially with all this cash these companies have, just dole it out
Yeah,
and
but
increase the innovation factor.
I know a lot of folks are like, well, that's fine and dandy, Mark, but what about where we are now?
Mhm.
Okay, so let's say I'm gonna just run it from scratch here. Um, so I'm gonna delete some things because I already had it drawn up, but I want to give it the full effect that it deserves, so to speak.
Okay.
Um, let's see here. We're gonna get rid of this one, and then we're gonna go to this one, and Boom. All right. Let's look at a chart, shall we?
Yes. Love a good shirt.
All right. Here is our wonderful handy dandy friend, aka the spy. Now, do we notice anything about this spy?
Hold on. My screen's not on there yet.
It's okay.
Okay.
I'll pause for the effect.
Yeah, there's a major delay on this one. It just transitioned. Okay.
Okay. So here we have the S&P 500 Spyder Etf. You know, literally what everybody really paid attention to last year was this trend line in which that we saw nothing but, a trend in which that we said, okay, hey, if it comes down to this line, we'll bounce off of it. Another line in which that we saw that was also very, very telling last year was this line as well. Now, this was ultimately, pretty much more so on the top side. This was more so on the base side. So, and then another thing that we're going to do here is we're going to look at something on a vertical line. So, looking at it from the stance of here, we touched, here we touched, and then notice that we started getting a little
Levels
bit.
are
Yeah,
when you
so
say here.
I'm gonna get to it. I'm gonna get to it. So I'm just want to make sure that I have them documented for everybody first. All right, and here. So we touched a level of 319, and then we went up to 323, and then on the very, very baseline, we came up to 426, 431, about 446, and then of course 451. So notice how each time we kept forming even though that we went low, we were also at a higher low. And then on top of that, it's like, throughout the time periods, if you look at the time on the upper line on this chart, you see that essentially you can kind of like, label it pretty much on a monthly expiration base, that every monthly expiration pretty much turned into a time where the market would dip. So that was something that was very interesting. Now those patterns are ultimately gone and we're looking for something new. All right, so I'm going to remove these off of the chart so that way we can just kind of clean it up and everything else. So I wanted to make sure we could do a little bit of chart magic. Now, of course, we did another magic trick, which is in TradingView, they now provide you the ability to even pull up Elliott Wave. So we got that part, right? So clearly from the base side, we went all the way up to level 1, correction, level 2, correction, level 3, correction, and breakdown, right? Now, it's very, very interesting because you can kind of see them plain as day when we look at it from the perspective of this chart. But there's another line that I wanted to show y'all that kind of gets a little bit interesting. What if I was to take this bottom line and draw it all the way out, just like this? And if I remove, say, for example, this line, which, we don't really need to worry about the monthly expirations anymore. But again, it starts to look a little bit more interesting. Now, here's where technical analysis, we look at it and say, all right, well, are we looking at, say, for example, this could be potentially a flag that we could be, assuming. So pretty much, of course, to other folks, they say, okay, hey, we have this downside flag, but then also at the same token, we are starting to show some upward action here where we could possibly see a breakout. That could be very much so true. And then on top of that, as you guys have seen, when we see like the more parabolic the move is to the downside, as much as it is, I wish I could I'm gonna just draw it. As you can see, we kind of like move up in the same shape and pattern in source. And again, the more parabolic the move, the more parabolic it is back up to the upside. So could we be seeing that same type of parabolic move formulating here? So if that's the case, we could probably be seeing ourselves going back up to, say, for example, that level of 465, and then coming back down to possibly do a retest in E for about like 442, 445, maybe even coming all the way down to about 428, and then essentially going right back up to prepare for breakout. Because if you think about it, it's around the same time that essentially that the market tends to move on from, say, for example, a lot of the bad news. Again, it gets priced in. So if you were listening and paying attention to what we said about what the Fed mentioned, the market is really just waiting on what the Fed has to say as it pertains to what are the expected rate hikes. My projection for what those rate hikes will be is that we will be at a 1.25 as the federal funds rate by the end of this year, maybe on the high side of 1.5, but my base case is at 1.25. And
Mm-hmm.
of course, my bullish case would probably be at a 1.75 or a 0.75. But then again, I'm more so in the camp of the 1.25 if you add in the 0.25 that is already in existence. And so essentially we just do it as one full point. And essentially from there, as we move on. I think that that's one of the biggest things that the market is looking for is where, like, when do we start? One, two, what can we expect as it pertains to the target for the federal funds rate? And because of the fact that the market doesn't have any type of color to the conversation, that's the reason why essentially that we're here.
Well, we have about uh 12 minutes,
Wow,
and
really? Time
yeah,
flies.
we have some questions
Let's
though.
do it.
We can go through them kind of quickly. How can Visa benefit from inflation?
I mean, I think the thing is that when people think about inflation, they think that everybody stops spending. That's not true. People will still keep spending. I mean, the biggest things to look at is that essentially, will people continually want to travel and go see loved ones? Yes, or just to go on vacation? Yes. Um, Also, will there be food that needs to be purchased? Yes. Will there be birthdays and everything else? Yes. I mean, again, you know, in an inflation environment, I don't think that a company like Visa is a company that is really going to get hard. I don't think that that's them. I think that other services that may be tied outside of Visa could possibly be hit hard. Like for example, a Square could be hit hard. And the reason why a Square could be hit hard is because of the fact that given inflation, Square is judged by transactional volume as well, but more so in the sense of all those services that it also uses a la carte as well. Like when you think about restaurants and everything else, those things are highly predicated on an economy that needs to recover. With an economy that is not able to recover with demand on short side or supply on short side, but demand is on the high side, that does not help.
Mhm. Okay, so here's a question. The non-farm payroll jobs have been missing and the wages are rising. Is this an indication of stagflation?
No, and the reason why I say that it's not there yet is because again, you still have high demand there.
Mm-hmm.
It's one thing when you have them both as kind of like stagnant, where supply and demand are both pretty much like meh. Um, I still think that we are just in a simple inflation environment because of the fact that people still want to buy things.
Mm-hmm.
Um, and it's kind of crazy because it's like I look at high items like Xbox, PS5, chips, all those types of things. People still want to acquire those things, and yet at the same token, um, they're just not available. So the demand is very, very high, and it's not going anywhere, and it's showing us signs that it's not going anywhere. The problem is that the fact that the supply just isn't there yet.
Okay. I guess this is a personal preference question, but with volatility this high, does it make sense to buy deals now or wait until it settles down?
Nah, I look at it like this. For me, here's how my plan works. I'm buying in a high volatility environment. That's exactly what I did. Now, I'm not telling you to go out there and do the same thing. This is the reason why it works for me. And the reason why it works for me is because of the fact of how my strategy is. For me, it's like I play a lot of long-term positions, but also I insulate myself pretty well in box type spread positions where it could be a mixture of midterm, a few midterm positions, and then essentially a few short-term positions as well. So I'm pretty well insulated, and so I like to be able to buy in on some of that action. But at the same token, you know, I'm very much so very protected on the long term side. So I want to make sure that that's very clear. So when I see good prices of what I believe that are, hey, this is something in which that honestly I'd be foolish for myself not to take advantage of, given the timeline in which that I expect and what is it that I know that's coming out. Um, to me, I look at it as it's a day for me to go shopping. I look at it like this: if you think about the stock market, think about some of the stocks that you buy, as say for
Mm-hmm.
example some of the things that you would go buy at the store.
Okay.
Now, if the things that you love to buy at the store all of a sudden went on sale for like if let's say if you like to buy, let's say, I don't know, cereal. Your favorite cereal goes on sale from being, let's say, $5 a box to now like $1 a box. Oh man, I'm stocking up. I don't even care if I bought it at $1 and if it drops down to, let's say, 85 cents a box. I still got a good buy because of the fact that the high side was ultimately $5.
Mm-hmm.
And so I think the thing is that we get very much so spooked in the markets because of the fact that we see the volatility and we hear everything that's taking place. Again, I know the companies in which that I'm invested into. I know what they're capable of doing. I know exactly that they have strong leadership and everything else. My question is, would I rather, and I always ask myself this, months or years later, would I rather be the person sitting back and asking myself, why didn't I get into this position? Especially knowing that essentially that during those cycles of, volatility, that they don't last forever. We're
Mm-hmm.
going back to a marketplace where volatility does have its spikes. And you remember this, where the market would have moments in the year of volatility and then it subsided. I wouldn't want to be the person sitting back and watching everybody else, having the fun, especially when I knew that I could have been partaking a part of that. So for me, it's like it's a no brainer.
Okay. Um, Let me see. The Xilinx and AMD. This is a question about that. What does it mean for AMD price? Because it's hurting today on the news of its passing. Why? Please.
Actually, no, it's not hurting on the news of its passing. So, actually, there's something that was out earlier today, and this is why I tell people to know where we are in the economic landscape because there was actually something that had came out today that literally gave forth a lot of color and information to
Mm-hmm.
what actually took place. Let me see if I can find it. So there was actually something that came out on the data forefront as it pertains to chips and economic data. There was an economic report as it pertains to chip makers, and that ultimately caused a lot of your stocks to ultimately drop. It didn't help that the fact that you also had Lam Research had a bad earnings quarter, and on top of that, Intel themselves also having a bad earnings quarter. Also, take into consideration when you're the acquiring company as well,
Right.
um, you're also going to be hit the hardest versus the a company that's being acquired. They get all the roses. So right now it's going to be Xilinx taking the victory lap, and AMD is going to be like, okay, hey, I'm the bridesmaid. So I think that honestly, it's like, you have to give analysts time. It's not like they can like they just immediately have it. Where it's just like, okay, hey, boom, this is gonna take some time. Where one, the Xilinx, because it's a conditional acceptance of the acquisition. So some of those conditions have to be met. It's not a full fledged, okay, hey, yes. certain requirements have to be met first. But then again, it's like it's already in the bag. Um, but moving forward, I think that the biggest thing is that, though that is good news, that information still has to be priced in. And the first thing that's going to have to be priced in is that large acquisition of expense, which is probably going to go in the books probably in the next quarter.
Okay, so as we are, well, we have 3 minutes, but as we are getting ready to close out the month of January. I mean, I know we have Bill Monday, even though that's Friday. Anyway, what, given like what the Fed has said, in upcoming earnings and things like that, like what should we all like be focusing on? Should we still be focusing on, the 5 things we discussed earlier? Or what?
Can you say that again? Because it was...
So basically what I'm asking is, okay, so January is pretty much a done data, right?
Yeah, January's over.
Now, right. So now we're still in Q1.
Yep.
And we have we based on what the Fed said, we had this indication about what's going to happen in March. So we've had all this volatility in January, then we have February, and historically, well, I'm only speaking about tech really, but historically tech tends to, be down during this time with sector rotation. But we've already seen tech go through, major corrections. So, are we looking? We know what the Fed is, where the Fed is leaning towards, for March. So, given that information, do you see February being something that is completely different from what it's been in the past?
Yes.
Or do you see much of the same? Okay.
Yeah, I definitely see February being different because of the fact of the aggressiveness and how fast things moved in the month of January. It's not. I think that we could probably be seeing that February could be a retest month.
Okay.
So somewhere in mid-February, we probably start to see a retest of some of those lows. But now it's like, okay, hey, a lot of the time it's like the market kind of gets stagnant. The market kind of gets over, the issue and the news of the economic cycle, and sooner or later investors stop caring and ultimately move on to the next thing. It becomes pretty much like, a desensitization to the discussion because the discussion becomes pretty much old.
Gotcha.
So again, the biggest thing that we're seeing in earnings is that if you're really reading the fine print and looking at what's being said, not only in the report of what has taken place in the quarter before, which was technically supposed to be a weak Q4, but it wasn't, and then on top of that, guidance is also coming through, and you're starting to see that the guidance is actually pretty good. Sooner or later, it's kind of like everybody's sitting in that room. Like, imagine everybody's sitting in a room and we're all looking towards the center of the room, and there's like, let's just say that there's all money, just this large pile of money sitting in front of us, and you can only take what you can grab with you. And it's like, okay, hey, nobody. It's like as if there's no start sign. Like everybody's kind of like, you have some folks waiting for like the announcer to say go, but the announcer will never say go, and everybody just starts looking around and like, who's gonna go first? And I will say this also: be careful of also folks out there that are also like really, getting everybody spooking, finessing the heck out of the market. You know what? Though I may not like him, but I have to give him credit to where credit is due. Bill Ackman. Shout outs to Bill Ackman for literally finessing the entire market yet again. Like, if you think about it, he finessed the market in 2020, though that he was running a hedge, and then ultimately he used his platform to literally spook the market. He came forth and did it again, talking about, there was nobody talking about 50 basis points until Bill Ackman stepped out and said a 50 basis point move that that the Fed is going to have to make, thus spooking the market yet again, and then ultimately waiting for and then letting companies like Netflix take the fall, and then all of a sudden coming in and buying up over 3.3 million shares of the stock.
Yeah, that's a lot of money.
Like, yo, if that's not the greatest finesse, like, understand this, people. Welcome to Wall Street, where there's a potential finesse move on every block. So just remember that. Yo, we got Magneto people out here trying to bring down X-Men. We got a lot of Decepticons out here that are literally saying that, okay, hey, that this is what it is, and yet all of a sudden they're trading something in a completely different manner. So again, pay attention, because oh man, like yo, you would think that people would learn their lesson when it comes to people like Bill Ackman, and unfortunately,
the noise, but they haven't. And we have a lot of,
it goes to show how many investors out there still pay attention to the noise.
Yeah.
Like, and it goes to show you how many folks out there on Wall Street could literally put forth, X amount of how much. Like, think about it like this. What was, like, ask yourself, like, go back, and I'm going to give you guys some homework. Before the stock market, what was the biggest thing that you were afraid of? Like, what was the biggest thing that you were afraid of before the stock market came around, before you got involved in the market? What ultimately gave you FOMO before the stock market? What were some of those things? What gave you anxiety before you became an investor or a trader in the stock market? What were those things? And then essentially as you go back and look at those things, I want you to also ask yourself, what caused the anxiety? What was it that triggered your anxiety? And then after that, now I want you to go back, and now I want you to come back to the current and say, okay, hey, what are the things that gives me anxiety about the market? What gives me FOMO when it comes to the market? What are the triggers when it comes to the market? You got to become aware of those things as it pertains to triggers. Because honestly, it's very, very interesting, but there are things out there that sometimes you may be thinking that you're dodging bullets out there, or that you're running from bullets. But in reality, when it comes to the market, those bullets are not bullets at all. They're just blanks. So, and Bill Ackman and people like him, and there's a ton of people like him on Wall Street that do that a lot. So just something, to be attentive to.
Well, we're 4 minutes over, but I do want to say, one, we have Supplemental Sunday on Sunday, 5 o'clock Pacific time, 8 o'clock. Wait, is it 5? Yeah, 8 o'clock Eastern time. We have a new Wealth Rituals episode dropping on Saturday. You have to be subscribed to know when the time is. We're not announcing the time ahead of time, so you just need to be ready. You got to stay. Yeah, you got to get in where you fit in. And also pay attention to the 5 things that we discussed earlier in the video for the whole year. If you don't remember what those are, you got to pawn the replay. So do that. And then also, Mark, you were talking about S-curves, and I had to ask Tivo, aka Father Time, what episode, what was the name of the episode that was covered. And so for that, it was Wolves in Sheep's Clothing. And it's at the 52 minute. Yeah, it's at the 52 19 second mark. But actually the whole video is good, but just pay attention to those S-curves and how, like, try and track where certain companies are in their innovation cycle. So when you're looking at earnings, you compare that with the visual of the S-curves. And if you don't know what I'm talking about, then go and watch that video, Wolves in Sheep's Clothing, okay? It's on the channel somewhere.
It's very interesting that it's wolves in sheep's clothing, and then here we are talking about the Wall Street Wolves here. Huh.
Yeah.
Anyway.
That's 6 minutes extra, y'all.
That is. Well, I know that we used a bunch of time, and there's a lot to study and everything else. But please, if you can, tag the Come Up series, and even tag myself and some of your findings and everything else, because we want to know. We want to know exactly what are some of the things that that haunt you, and also what are their parallels to you being in the market today. Hopefully, we can find some. Until next time, I'm Mark Monroe.
And I am jolyngc, and the place to be.
And don't forget that the more you learn, the more you earn. We will see you on Tuesday. Have a good one, everybody. Peace, y'all.
Bye.